Joining us now is Ron Josie, U.S. Internet Analyst at Citi. Ron, welcome. Good to have you here. I guess if I'm reading my notes correctly, one of the reasons you are favorably inclined towards this stock is that you see margins potentially expanding over the next couple of years. How can the company do that at a time when they are having to spend as much as they are spending on capital investment in the cloud and in AI?
Tyler, thanks for having me. And that is the question, really. We're at a point where we think AWS demand is actually accelerating. And if it's accelerating, we should see revenues coming up. And ideally, it's accelerating not through optimizations, call it attenuating, as a company likes to say, but through new instances doing better. That's higher margin revenue. So that's AWS. But Tyler, the real answer to the question, in our view, is that I think the core retail business is actually becoming more efficient. We started seeing this, call it last year, with the implementation of their regionalized shipping zones in the US. That's rolling out overseas. We're seeing new fees come out. We're seeing basically a shift from consumer demand being mostly discretionary, or a lot of it discretionary, to a lot of it being non-discretionary. And if we're getting our goods faster, that means we're using Amazon more. And I think they're clear to say one of their cheapest or most efficient form of delivery is the quickest. So frankly, I think they're becoming more efficient in the core retail business. And as AWS improves, we think that margin can at least sustain itself as the retail business improves overall efficiency. And I think there's more room to go there.
They seem not only maybe to be more efficient, but just better at getting more goods in the hands of consumers quicker.
I mean, that's been a game changer. I think same day, next day delivery just opens up so many different opportunities for them. We saw recently the launch of a new Prime add-on for grocery. I think $9.99 a month for grocery orders over $35. You get it within several hours, sometimes within the hour. But the bottom line is, if you can actually rely on Amazon for more of your goods, whether it be paper towels or shaving cream, whatever, you're going to rely on it more, and scale begets scale here.
I wanted to send a really romantic thing to my wife, and the cat litter arrived that afternoon. I mean, it was
that's impressive.
It was impressive, man.
But internationally, that's not the same case, right? So what are they doing on the international front to have similar margins that they have here in the U.S. and make that work?
Yeah. So, Seema, a few things. First and foremost, what's driving here and now retail margins, in our view, is the advertising business. That'll be around $55, $56 billion this year alone, growing 20+% on our numbers. But as the core retail business becomes more efficient, that's going to drive margins overall. Internationally, advertising helps, but as importantly, there's a lot of these emerging markets that they've been in now for 5, 7+ years, and it takes about 7 to 10 years to reach that profitability threshold. We saw Mexico reach profitability, I believe, in 4Q. That was about 8 years after launch. So really, we're coming to a level and scale here in more of these emerging markets that they're getting to the size that they can be more profitable. And just taking the largest markets overseas, which are Germany, UK, Japan, you're getting this new, call it, benefits from the regionalized shipping, where I think they're shortening the distance to delivery and therefore getting goods to users faster. And we think that flywheel effect just gets stronger and stronger.
So that's retail, that AI. We talked about cloud. What about its dividend, or a potential dividend? I was just looking at the S&P 500 companies with a market cap of $1 trillion or more. They're all offering a dividend: NVIDIA, Microsoft, Alphabet, but Amazon is the one left out. Do you think they changed that today?
I'm not too sure if it's today. I'm sure we get some insights this year at some point around capital allocation. We're looking for, this is a business that has a significant cash balance on its balance sheet. In our view, as we just talked about, OI getting more and more profitable around retail and AWS as well, I think capital allocation has to be a question on today's call, whether it's buybacks first and then a dividend. But frankly, we saw the benefits with Meta. We're seeing, obviously, Google institute a dividend. So certainly a change in approach across my coverage universe in terms of capital allocation, both on buybacks and then increasingly dividends.
We'll be watching. Ron, thank you. Ron Josie of Citi Research.